Okay, that I'm hoping is now. Yes. Okay. Sorry about that. Okay. Okay. Well, I'll start sort of again because you may have missed that. But yes, you've got here the shorter moving average, which is your which is your green line, and your 12-day moving and turning up, and that comes back towards that longer 26-day moving average. Hence the distance then starts to come back and narrow, and therefore MACD line turns higher. As I said earlier, the point at which the MACD lines come together is the and crossover is the neutral line, or the zero line, and then as you move from negative to positive, that is the shorter moving average moving above the longer. At the top here, again, as the distance tops out and the two moving averages start to come back together again, the shorter moving average starts to fall away, and then the MACD line falls away as well. Okay, so there you have your chart, effectively. There's another element onto this chart, which is the Macd Histogram, and that is, I will explain that at a later date, in terms of later in the presentations. And within this also you've got the signal line as well, which the signal line is just a moving average of the MACD line. It's the 9-day exponential moving average of the MACD line, and that basically just gives you an extra confirmation. So when you move through the analysis, you will see that in a bit. So I will talk about now the changing parameters. Basically, you can have. It depends on your specific trading mindset whether you use the parameters that were laid out by the inventor of the MACD lines, or you can use something completely different. It depends on your style. I've given here an example of using 9 and 21 instead of 12 and 26. The classic uses of 12 and 26. I've changed that to 9 and 21, which is shorter, and also having a 7-day exponential moving average instead of a 9-day exponential moving average as your signal line. Now that should subsequently mean that you get a much better and more quick signal in terms of if you're a short-term trader, because as with all these technical indicators that I talk about, RSI for example being one, where you use a shorter number of entries for the calculation, you get more of a volatile move, and hence you get more trading signals. But you do have a tendency to the caveat to that is that you have the potential for more false signals coming through, so you've got to be careful of that. But you can see on this, annoyingly my computer is just dying. Anyway, you can see on this this comparison here, you've got a bit more of a whipping motion in this shorter version of this. In terms of trading signals, I suppose you'd go along here. It's not drastically different actually, looking at this, which is dollar Kiwi. Maybe if I go back a little bit further, you can get more. It's. I think this. I mean, this chart's moved on since I put it together a few days ago. But yeah, maybe. I mean, it just means that you get more pronounced moves, basically, in terms of the move to the upside. I mean, if you these moves that bump along the bottom here, you could argue that you get more of a false signal, perhaps, as opposed to the longer dated moving average convergence divergence that doesn't necessarily give you that early signal that maybe you do get with the shorter versions. But it's always each to their own, really. I mean, in all of these parameters that you do, you should go away and do your own research, do your back testing, make sure that you've you're comfortable with how the indicators set up, because it is the most important thing that you can do in technical analysis, that you're comfortable with how you've set your parameters up. Otherwise you end up trading and you don't have the conviction of your trades, and you end up without any real backing for your analysis, and it just becomes a little bit harder for you to trade. So you need to do your own back testing, in my opinion, before you can really be confident in your trading. Okay, so we're going to be reading the MACD lines now. So annoyingly, I actually had a couple of slides back here that I didn't show you. Oh, it was only one, so fine. Okay, there we go. There's that first slide. Anyway, okay, so that's the MACD lines with the parameters. You've then got your changes to the parameters. Do your back testing. Okay, so signals. What signals can you get from the MACD lines? Well, as I said in the chart just now, the actual MACD line itself changing direction is a signal in itself, in the fact that it just shows that previously, say for example, if it's turning lower, it just shows that previously positive momentum is now slowing, and the two moving averages are beginning to come together, which would suggest you've lost a bit of that upside impetus. The shorter moving average is beginning to turn back and come back towards the longer moving average, which that would suggest that near-term momentum is deteriorating. Equally, if the moving averages turn higher, if the MACD line turns higher, that would suggest that the moving averages are improving, and the momentum also improving. You've also got crossovers. Now, crossovers are a trading signal that I will go into in a little bit more depth in a bit. But just to touch upon it here, basically, it is a signal that incorporates both the MACD line and also the signal line, and can give you an early trading signal for that. It basically suggests a confirmation of the change of direction, because you've got the MACD line that changes direction, but it can also equally it can equally just stay around where it is trading. So once the MACD has a crossover with the signal line, that would suggest there's a confirmation of that reversal. And finally, moving through the center line. Now, I think this is actually a very important signal in the MACD, basically because I like to use I like to talk about positive momentum and negative momentum a lot. And the fact is that you can have the MACD lines, which I will show you again. Just where's my chart? You can have your MACD lines. Basically, they can be rising, but let me just show you in a spot on here. Find it. Here we go. Okay, fine. Okay, you can have your MACD lines falling, but you've still got positive momentum, which suggests that it can just be a retracement within a strong trend. Now, this is what I think this chart is telling me here, is that obviously we've still got this strong trend going here and pulling cable higher. However, what you actually have got within this is a correction within that trend. Now, you've had the MACD line staying in positive territory all the way through, but they actually give you a very strong, in my opinion, signal here, which is just a retracement back to the center line, and then you get a strong signal again to the upside. Now, I believe that is an underrated buy signal, because just reading through some of the analysis of the original theory, it would suggest that the buy signals theoretically should come. A buy signal should theoretically be this crossover down here, and not necessarily a crossover around the center line. Now, I would say that I would rather buy a crossover on a retracement back to the center line than go on the gamble that you're having a big trend reversal, because one thing that an experience has told me in technical analysis is a lot of trading, if you're well, certainly the trend is your friend, and I think a lot of trading mistakes come with you believing that there is a trend reversal going on when in fact it's just a retracement within a bigger trend, and then you sort of make the mistake of effectively trading counter trend. Now, I would say that in an ideal opportunity, you would be buying this crossover here. This would be my favoured buy signal here around the centre line, having had this big strong trend. But that is something that I'll show you in a bit on some other charts anyway, so we can go through that. But as I said, you get your moves through the centre line, which would suggest if you're, say, for example, moving from negative and below the centre line to above the centre line, that would suggest positive momentum. Momentum is building because the near-term moving averages. The near-term moving average is pulling away from the longer-term moving average, and that is something that you want to be in. Okay, so as I said earlier, you've also got a histogram, which is, again, a very important part, I believe, of the Macd lines. In fact, it wasn't actually part of the original theory of Macd, but was actually added in about 25 years ago. And it has, I believe, got a significant amount of use in Macd analysis because it gives earlier signals. It basically, the Macd histogram is the difference between the signal line and the Macd. So basically, when the Macd line, the red line, is above the green line, then the histogram will be positive. As the lines cross over, the Macd line will be neutral. Sorry, the histogram will be neutral, and then as the red line falls below the green line, that is your histogram going negative. Now, as per usual with a lot of momentum indicators, you use divergences a lot of the time are very useful because it just shows when gives you an indication of the price, where the price is moving, but the momentum is not as strong. So that gives you an early signal of a reversal. And I will be able to show you that in a minute. Oh, that's a little bit early for that chart. So back here. Okay, so that's your histogram. And what do histograms give you? Divergences and crossover trading signals, etc., etc. So just gives you added bonus of an earlier pattern as well. Now, in terms of where you get these, normal trading systems will give you the histogram, or maybe they'll call it the Macd forest, as part of your Macd indicator. Some of them, I know, for example, MT4, which our clients use, will get the histogram automatically, so it's not something that you need to worry too much about in terms of whether how to set it up, because it will configure it automatically. Okay, so crossovers. Okay, I've just got a question here. Could the Macd give a signal for the last big sell-off in the sterling dollar? Okay, well, why don't we have a look? It is sort of part of my analysis anyway, but why not take a look now? I could imagine it probably would have done. There you go. There's your crossover. Not only did you get a crossover, we haven't really gone into divergences yet, but I'll do it anyway now. Not only have you got a crossover, you've got a bearish divergence, which then on the Macd forest or histogram, you then get your confirmation sell signal, which is your Macd cross, and then bang, that's gone. And yes, it was a very strong signal. So yes, if you'd have played the Macd lines with cable recently or 2 months ago, you would have been in that trade all the way. So that's good. Yes, so that was a good signal there. Do I not like candles? Well, yes, I do like candles, and that's evidence of it in this chart. It's just the fact that sometimes when I'm trying to obviously show you indicators, it's just comes a little bit easier. That it just comes a little bit easier for you to see exactly what I'm talking about, rather than getting a little bit distracted by the big colourful candles. But that's just purely for aesthetics. But yes, I do use candles an awful lot in my trading, and yes, I think it is a very important. Gives you very important signals as well. Right, so the crossovers. Now, I sort of touched on crossovers just now. Your crossovers that you get here, there are two different ones on this diagram here that I've got, and that's your crossover at the bottom of a trend, and also your crossover within a trend as well, which is your effectively a retracement crossover, which I think is a very powerful crossover here as well. That, as I said, is theoretically not necessarily correct, but I believe is very good and very useful. Anyway, your crossover is basically your Macd line crossing above your signal line on a buy, and that's obviously a bullish signal. Your sell crossover is where the Macd line here crosses below your signal line, and is again depicted by your histogram going from positive to negative. Right. I will show you all these in a minute, but I just want to get the theory out of the way because it can be a little bit complicated if I'm sort of not really showing you on the screen. Anyway, so you've then got the divergences. These are the other big major signals that you get from Macd lines. As I said, divergences are a big feature throughout momentum trading, and do we need indicators as they are a derivative of prices and lag? Good question. Whew. Right, okay, well, indicators, yes. Okay, let me just try and get this one. I believe, yes, you do need indicators, because you can't, although the price in theory tells you everything you need to know, I think you still need to find just things that, say for example, moving averages. Moving averages are a lagging indicator by definition, because they take into consideration price action of X number of periods ago. However, does that mean I don't want to use moving averages to give me signals? No, because I think that it gives you a very good indication of trend. It gives you an indication of trend reversals, support resistances. It's all sorts of things that moving averages give you. Now, obviously, you can take your moving averages and then you make that into Macd lines, because that is, again, Macd is a derivative of a moving average. So therefore, you would argue that I think Macd lines again are very interesting because they give you another. Indicators effectively just give you another feather in your cap. They give you more information than you have just staring at you with a couple of bars on a price chart. I believe the more information you get out of your technical analysis, the better. Because I prefer to trade off multiple confirmation, and I would rather just have as much information as I can get my hands on, and then I can sift through it and use that accordingly, rather than just trading off pure price. Because I think as I said, momentum indicators show you that, especially through divergences, which is takes me nicely back to this slide here, that just because the price is going higher doesn't necessarily mean that it's going to be going higher for that much longer. You want to be prepared for that reversal. Now, your divergences here that you've got on this Macd theory sheet, but I'll show you in practice in a minute, just show you that you can have the price moving higher from higher lows and higher highs. However, ultimately, you can have also the Macd lines beginning to turn lower, the histogram beginning to turn lower, bearish divergence on the Macd lines, bearish divergence on the histogram. Now, if I didn't have that as an indicator, would I know that that was coming? Well, no, because not necessarily, because it gives you an early indication of what might be going on. No indicator in technical analysis is foolproof, I'll give you that, because obviously otherwise everyone would be millionaires. But it gives you, certainly I think divergences give you a very good indication that changes of price action are on the way, and that perhaps there is a change. Perhaps there's a change of trend in the offing, and you need to be prepared for that to happen. Certainly, if you're running long positions and you've got a bearish divergence in your momentum indicators, do you still want to be running that long position? Well, if I'm in that position, I would rather have the knowledge that I'm losing upside momentum. I can then have my price profit triggers nice and close to the price. So just in case that the sell-off does start to happen, then I don't lose too much. And I think that momentum indicators, certainly in this instance, the Macd lines give you a very good indication of what's could be about to happen. So you've got your bearish divergence here, and that is basically where you've got higher highs on the price, lower highs or lower peaks, or falling Macd lines, and that gives you the indication that there is deteriorating momentum. The opposite to that is your bullish divergence, which obviously is lower lows on the price, but the Macd lines turning higher and beginning to move upwards. Okay, so let me just show you all of that, because there's a few indicators there on here. Now this is euro dollar. Across the course of about a year, loads of different signals on euro dollar, lots of arrows, lots of lines, and I will take you through several of them. Right, okay, so now, the first thing you'd identify, as with a lot of these indicators, is the sort of trend you're looking at. Now, I think through here, basically, it's a fairly, in terms of a macro trend, this trend in the euro dollar at the time was fairly sideways. So you'd probably be trading just on a near-term basis, and you wouldn't want to be. You'd want to be sticking close to your profits, because there's no real trend that's emerging here, and you know that as soon as you get a reversal, the chances are you're likely to retrace all of that move anyway. So you'd be still trading on your crossovers within this scenario, and you'd be using your sell signals as shorting opportunities and your buy signals as long opportunities. Now, so the reason I started here was just purely arbitrary. There's no actual reason for it, so I just move this forward here. Okay, so we start here. We've got your first crossover, and how many times does this crossover work? Well, a lot. In the course of 1, 2, 3, well, you get 3 signals in the course of 2 months. Two long positions, 2 short positions. So 2 long positions and 1 short position, and ultimately they will work very well. You then start to see a bullish divergence forming. Now, the thing with bullish divergence is they can go on for a while, which is why, as I said in my little diatribe a little bit ago, I basically said that you want to be sticking close to your profit, and you don't want to be necessarily coming out and using divergences as absolute pure signals for trading, because you can basically miss out on still further upside. And here, for example, you've got your divergence in the MACD lines that go on for across the course of almost a month, really. And because of that, you still don't necessarily want to be losing any of that position. So maybe you'd be sticking close to your profit trigger. For example, you've got that low there, that reaction low at 31.88. Maybe you'd be sticking your stop underneath that. So if you started to breach that low, certainly having hit that high there and starting to see a divergence, you maybe start to think, well, okay, this is something that we need to be close to in terms of profit triggers, and I don't want to necessarily lose what I've got. Now, I believe that in terms of your trigger on your divergence, the big trigger comes with a significant break, and that is where your lines begin to accelerate, because throughout this course of this time here, the lines have basically just been sort of moving sideways, not really been going anywhere, and I think it's only when it starts to really accelerate away, and that was on this day, trading day here, that you begin to really get your signal, and I think that is where you get your sell signal, when you get the lines just accelerating away. Now again, as I said earlier, you then get a turn up, because the signal line never actually went into negative territory, which is interesting, because that would suggest, in my opinion, that you're holding on to your bullish momentum on a longer term basis. And ultimately what happens is then you start to build a big trend that goes higher, and you get this crossover that ultimately once again gives you a signal that works really well. Now you actually do then get a crossover sell signal there, so the big question is, what do you do with it? Well, my opinion is that you've broken out actually above all these highs, and in breaking out above the highs, I think you start to contemplate whether you're starting to build a trend, because you're sort of moving away from a sideways trending environment, maybe towards a more of a big uptrend. So maybe in this scenario, you'd start to think of maybe the sell signals start to become more profit triggers rather than outright shorting signals, because you don't, once again, as with technical analysis, the signals come best when you're trading with the trend. You get your best signals when you're trading with the trend. You want to be buying in an uptrend, you want to be selling in a downtrend. You don't want to be shorting in an uptrend, because that is which you get your false. You basically have the likelihood is that your hands will get burnt, and I believe that at the point at which you've broken out here above the resistance, you start to think, and also having gained support above that resistance as well, you start to think, okay, well, I think we're going to start to build a bit of a trend going on here. So I'd rather be using sell signals here as profit triggers rather than shorting opportunities. And ultimately as well, you can use keep your stop. Probably you'd be putting your stop underneath these lows anyway, and ultimately if you'd done that, you would have still maintained that position in the trend, and you would have continued to make gains on the upside. Now, having said that, we then get a reversal, and if you had shorted in that little sell-off, you would have actually done very well. But me personally, I would not have been doing that, because I think it's a risky strategy, because as I said, I think you're now moving into a situation where you're trading on the long side because of an uptrend, and I'm now starting to look for long opportunities, and I get another long opportunity here with another bull cross, and ultimately, yes, once again you get this move to the upside. Now here we go. I have had a question about a bull, a cross and a kiss. Now a kiss, I believe, is a powerful signal, actually, because basically a kiss is where you get the two lines coming together, but you ultimately don't get your crossover, you get the lines accelerating away from each other again in the same direction. So that, I believe, is a similar sort of pattern. Say, for example, you think of it's sort of like almost a consolidation within a current trend, which in this instance is corrective, because as I said, you've basically it is a corrective trend within the big uptrend. So you've actually got a crossover, which effectively gives you the suggestion that maybe there is a correction coming, or at least you'd be looking for your profit trigger to kick in. You then get a kiss to the downside. Now, I think on that second kiss, you're then thinking, okay, well, maybe there is something that I can do with a short position. Maybe not go all out, because you're obviously trading against the trend. However, as I said, I believe a kiss is a pretty powerful signal. It suggests basically a consolidation and a continuation within that trend. Now, having had this crossover signal here, you start to think, well, maybe there is a correction within this trend, and ultimately you do get one. It lasts for about 6 weeks, so ultimately you do get one, and then you start to get a bullish divergence on your histogram, and that's the point at which you start to think, well, again, I'm getting a bullish divergence on the histogram. I'm not really getting much of a correction in the price. There's not a great deal of selling strength that's going on. So maybe that the corrective trend is once again coming back towards support. And ultimately, what happens here? You get a move back towards the support of these lows here, and effectively around these breakout highs as well. This breakout high here from August. And you start to find support around that level. So again, you're starting to think, well, okay, maybe I'm looking for some long opportunities once again. Now, you don't actually, I didn't, well, yeah, you do actually here, because you get your crossover within that, and that comes after the bullish divergence. So yes, you do actually get a cross that I have missed off this chart, but anyway. And then if you traded long there, you'd have been in here. And then you've also got your another bull kiss, where you've got your two moving averages that come together and bang, they accelerate away from each other. Again, I believe that is a powerful signal. And ultimately here, what do you get? You get that the day before this very big, or basically on this day here, where you get a nice big move to the upside again. So I think that this chart of euro-dollar certainly suggests, in a trending environment, that you get a lot of bull signals that you can trade with, and I think that it is a very successful strategy in a nice bull trending environment. Now, big question is, does it work on an hourly basis in terms of short-term trading? Well, I believe yes, it does. This is euro-dollar on an hourly basis over the course of about a couple of weeks back in August. And so if I zoom out slightly, you probably get a bit more gauge. No, you don't want to help me? No? Okay, don't respond then. Okay, well, I'll just let that crank up. Get the anyway. Right, there you go. Okay, fine. Here we go. Okay, so you've been in this big sell-off here, and you're starting to think about, that's across the course of the last few weeks actually, and then you start to think about what sort of signals you want to be getting within that sell-off. Well, I want to be shorting in that, and ultimately you get a very good signal here, which comes around the key resistance of this move. So I'm getting a sell signal, a bear crossover sell signal at a key resistance point. That is an ideal selling opportunity in my book, and ultimately, yes, that's around 34.20. You get 80 pips to the downside within that selling opportunity across the course of the next couple of days. What's going to happen now? Well, you get a bullish divergence. Do you buy a bullish divergence in a downtrend? Well, probably not. You probably just use that as your sell signal, to be honest. Sorry, as your profit trigger for your short. And ultimately, I think you'd probably be using this any number of these opportunities here. You've got a bullish divergence on the histogram. You've got bullish divergence on the line. So probably you'd be using this in divergences. In my opinion, if you're going to trade them, use the second crossover as your signal. If you're going to trade them at all, and I think in this instance you would have you've used that as your profit trigger for your short position. Okay, you're still in this big downtrend, and you've basically just returned to not a million miles away from that resistance point again between 34.20 and 34.40, and you've got another bear crossover, another one, and another pretty easy, strong down momentum. You've got that downtrend in the price. You've got a downtrend on the Macd lines, and you've got a bull cross to give you your nice profit trigger on your short position. And it is I think that's I think the on an intraday basis, I think they do work very well. There don't seem to be any more. But yes, if you can identify a trend, I believe that the Macd lines work very well, and they are a very useful indicator to have. Okay, so what I thought I'd quickly do is just take you through here, take through some of the current state of play. Now, this is Euro Dollar. I'm going to bring in RSI and also stochastics as well to add a little bit of spice to it, but this is unbelievable, isn't it? If you look at the wow, it's just incredible, isn't it? The big sell-off that we've seen in Eurodollar. Now, what are you looking at in terms of signals that you can use? Well, to be honest, you're so bearish on these momentum indicators across the board that it would be incredibly risky, I think, to be buying into that. At some stage, there's going to be a big technical rally on Euro Dollar, I think, in the next. Well, I mean, if you think about the fact that the RSI is back at the levels that you haven't seen since September 2008, in the middle of the credit crisis, I think that you would say that there is certainly the prospect of a technical rebound, and I will show you back in September 2008, if you bear with me with your eyes. These are the levels back in August, September 2008, where we got the RSI back down at those levels, 17 on that. And you were thinking at this stage here, you've had this big sell-off, this is going to go on forever. Well, does it? No, it doesn't. You actually get a rebound from 138.80 to 148.65. You get well, I mean, that's ridiculous. You get a 10 big figure rebound in euro in the space of 2 weeks in that time. And that is from the point at which you've got the RSI sitting at 17. You've also, well, I mean, the Macd lines, to be honest, you actually get a crossover there, so you've got arguably a rebound signal if you want to trade it. I think it's probably more to the fact you'd be using it as a profit trigger on your shorts, but still, if you're a very brave trader, you can get in on the back of a buy signal, or just an extreme signal on the RSI. You also got a crossover buy signal on your stochastics as well. So I think you're looking for signals such as that at the moment. You're nowhere near it at the moment because all these indicators are still deeply oversold. I mean, look at these stochastics and Macd lines, nowhere near having any sort of crossover or divergence or anything. So I think that at the moment you're looking pretty pretty negative still. There's no real prospect yet that the technical signals are suggesting a rebound in euro dollar, but still, at some stage, I believe that there will be one, because, in my opinion, I know I'm a bit of a contrarian, and you can argue against that all you like, but I still believe that the stretched nature of these momentum indicators would suggest that at some stage soon there's going to be probably a fairly sizable rebound. Cable's even worse. Cable is just ridiculous. I mean, cable's lost 500 pips in 5 days. That RSI at 12 is just, I mean, that's just ridiculous. But again, these momentum indicators are so bearish that, to be honest, at some stage, as I said, that you're going to have to there has to be a rebound at some stage. And to be honest, it's probably going to come. I mean, if you drag in the fundamentals, obviously there's the big Scottish independence scenario going on, that Scotland might vote for independence from the UK, hence a significant uncertainty in sterling and a sell-off. But I just think that at some stage there's going to be an almighty rally in cable, and that almighty rally could well come, I mean, with that Scottish independence vote. But if there was a vote to keep the union, I think there's just going to be just an insane rally in cable. It's just going to be huge, and it could well be all the way back up to sort of 65 again, so like 400 ticks easily. But it just depends on obviously when it's seen, and the likelihood is that it's going to be probably trading around this sort of level, maybe with high volatility for the next week and a bit. But it's incredible. Another one, just ridiculous again, dollar yen. I mean, how high does dollar yen have to go now with this RSI up above 80? Macd lines, that is just, again, insanely strong. Very strong momentum across the board on dollar yen. I had a question about my moving averages. I use Fibonacci moving averages 21, 55, 89 and 144, and the reason for that, Fibonacci levels, and I like to just have that as my confirmation that just gives me added confidence in the moving averages that I use. Really, no major difference, and just ones that I've always used. So yeah, dollar yen broken out. That's again a multi-year high. I mean, these forex markets at the moment are just crazy. Dollar yen again doesn't look as though it's stopping today. You'd probably be looking to buy. Dollar yen's probably the one that you'd be trading the most, actually, on the long side, in my opinion, because the other two, euro dollar and cable, are just so fundamentally driven at the moment, rather than dollar yen, which you could argue is more technically driven, I think, at the moment, that you would give, I think, dollar yen more credence for its breakout, and for that reason I'd be using any sort of rebound, correction back towards this 105 area, 105.50. You've got 105 support as well, 104.50. Anything back towards like 104.50 to 105.50, I think would be a strong buying opportunity. Look at this RSI up at 80. Every time that's happened in the last month, you've had a consolidation of maybe 100 pips. So I think it's probably not the worst idea just to wait for a bit of a correction and then going along on dollar yen. Okay, can you look at Aussie Dollar? Yes, I can. Aussie Dollar had a big sell-off today. It was a technical reason, but look at that. It pretty much bang back to that 92 big figure level, and that's arguably held, I think, as well. It's not. I think if it closes above 92 big figure, then you're still in the game. But that Aussie Dollar, well, I mean that it is coming in front of a key unemployment bit of data for the Aussie, so that could be speculation in front of that. But you would still be trading that, I believe, as a range trade. You've got 92 big figure hit, 1, 2, just above it there, 3, again, a couple of lows here, 4, 5, and then again today. So I would just continue to play that as a range trade as at 92. If it closes below 92 figure tonight, yes, then maybe that relationship is breaking down, but there's no real indication yet on these momentum indicators. This RSI, again back to that 38 level, which is pretty much where the corrections have all come back to 92. So it's not, in my opinion, breaking down yet. If you start to see the RSI back into the low 30s, then maybe that is breaking down that big trading range that we've been in for months and months. But at the moment, I think that I'm going to give it the benefit of the doubt, not go too hot-headed into this, because I think you'd need to certainly have a close below 92 figure, and also I'd like to see that RSI starting to dip towards the low 30s. In terms of stochastics, they're still just bordering positive, but rolling over. Macd line's pretty neutral. You wouldn't really want to be trading on that Macd. But yeah, I think it's still holding up okay. Not to say that it's not under pressure, but it's still hanging on just for the moment. Okay, CHF, dollar Swiss. Anyone trade that? Well, dollar Swiss basically is a proxy for the euro, because of the 120 support that the Swiss National Bank has. And if you switch this chart, flipped it around, it would look pretty much like euro dollar. So hence why we've seen a significant upside break in dollar Swiss in the past few days. It is incredibly overbought. RSI up at record levels, but again, at some stage, as with that euro, I think that there's going to have to be a big retracement, or a retracement of some degree. I don't see that this is going to go one way forever. These things never really do. And I think you need to be prepared for the fact that if you're long of dollar Swiss, then you need to be just prepared for the fact that there may be a correction at some stage. What do I mean by proxy? Well, I mean the fact that it's basically exactly the same, but I mean the fact that the Swiss National Bank pegs to the euro, or basically looks to have a floor of 120 to the euro, just tells the market that it's going to be a very similar story, and hence why dollar Swiss always moves in a complete inverse correlation to the euro dollar. Right. Okay, so very quickly, gold, because I'm a big fan of this gold chart at the moment. I'm happy with the way I'm calling it on a consistent basis. Let me just give you that. I haven't drawn it in here, but I will very quickly do so. You've got a particularly nice downtrend channel that is dragging gold. What have I done there? That is dragging gold back towards... Why would you not work? Anyway, that downtrend channel that I'm about to draw in, if I ever get the opportunity to. Here we go. Okay. That is pretty good, in my opinion. Downtrend channel that continues to drag gold back towards this 1240 level. Look at these momentum indicators, all in bearish configuration. Lower highs, lower lows. RSI back towards 30, so you can argue becoming a little bit more limited in its downside potential. Maybe you'd be still looking for your selling opportunities back towards 1280. 1273 is a resistance. 1280, between 1273 and 1280. And yes, I believe that gold is beginning to certainly come under pressure, and to the downside, that is a bearish outlook for gold. So, just to wrap up, really, we have been talking about the Macd lines today. We're going to be doing Bollinger Bands next time on my Handtech webinar, which you can join up very simply to at handtechfx.com/webinars if you've enjoyed what we're doing today. Now, Handtech Markets is just a little bit of background about Handtech Markets. We're a London-based UK-regulated broker specialising in forex, bullion, and CFDs. We have retail clients, we have institutional clients, so we cater across the board. Now, what we're doing at the moment is we've got our third annual trading contest that we've got, and it's called the FX Trade of the Year 2014. It's run on our demo platform, and we have that actually in partnership with FX Street. And we've just today, I believe, opened up registration for that. So if you enter into that, you've got the potential to win an $18,000 prize, I believe. So that's interesting. That's a very odd number, okay, for a winning total, but okay. And the winner receives my God, I can't even read. Total prize sum of £18,000. I still can't read. $18,000. Phew, it's been a long time. Okay, so the winner receives $10,000 for that. So if you that's within a live trading account. So the webinars that hopefully I'm taking you through now can help you in that competition if you choose to sign up. It was a very popular competition that we've run for the past couple of years, and I wish you good luck if you do choose to run that. So it sounds like fun to me. I might even do it myself. But yes, so if you look at the Handtech website, we've also got research on there as well for you. I do daily morning reports, I do analysis videos, live analysis that I post on the website. I also do strategy reports, and yes, so there's a lot on there. I also got a Twitter handle at HandtechRich. If you're on Twitter, I'm sort of reporting about market news and everything going on, so hopefully you'd find that interesting as well. So we do an awful lot of Handtech Markets that hopefully you can find interesting and useful, but I would certainly recommend signing up to this FX Trade of the Year contest for 2014, because it certainly sounds like an interesting game to play, certainly if you can win 10 grand anyway, so that would be incentive enough as it is. Anyway, so I wish you good luck in all your trading. I hope you found what I've been speaking about useful today, and I believe I'm doing another one with FX Street. We've just got to get it organised now, get a date in the diary. But if you're more interested, as I said, in seeing me again sooner, then we've got our own Handtech webinars as well, so you can sign up to them. But in the meantime, I wish you good luck with your trading, and I will leave you with my disclaimer for you to read and hopefully understand. But if I don't speak to you again, I wish you good luck, and I will speak to you next time. Thank you very much.